Hello and welcome to the Canaccord Wealth Coffee Break podcast. I'm Jane Parry and I'm the Chief Marketing Officer here at Canaccord Wealth. And I am joined today by Tom Hibbert from our Chief Investment Office. Welcome.
Hello, everyone.
Now, Tom and I have got a slight disaster this week because we normally sit here with a couple of black Americanos, fully caffeined out, ready for our conversation. The Canaccord coffee machine is not working this week. So what have you gone for?
Total disaster. I've had to go for instant coffee.
Oh,
and the worst thing
God.
is, my daughter was teething last night, and I've had about 3 hours sleep. So instant coffee does the job, but it's not quite the same, is it?
I've gone for tea. I'm not sure what's best, instant coffee or tea. It's just not cutting it though. But we'll try our best. We'll try our best to get through this podcast today. So as you know, this is based on the Weekly Markets Review, which is a newsletter we send out to subscribers every Monday each week. And what we do on the Coffee Break podcast is dive into some of the themes in a little bit more detail just to get a better understanding from Tom about what's going on in the markets. So please grab a coffee if you can and listen in for about the next 10 minutes and let's hear about more what's going on. So this week's conversation has been triggered by gold, which is booming to all-time highs as we speak. So gold is up 47% year to date, and silver is performing well too, up 60%. And all of this is as the US is facing its debt ceiling crunch time once again this week. So first off, Tom, what do we mean by the US escaping structural decline? I mean, I thought from our conversations in the last couple of weeks, actually, that the US was doing well. Markets seem to be doing well for sure. So what is going on here?
Yes, the US economy is doing quite well, and US companies are doing extremely well. So in fact, that could be the saving grace for what we're going to talk about.
Because last week we talked about fabulous earnings, didn't we?
Exactly,
yeah.
Exactly. The issue is debt.
Okay.
And the US has racked up a $37 trillion debt pile, thanks in large part to extreme policies and entrenched excessive spending over the last 15 years in particular.
So this is the US government, not companies.
The US government, exactly. And many other countries, developed countries, are in the same boat. Worse positions, actually, because they don't have the same quality companies like the UK, for example. But to understand what's happening here, I like to go back to the 18th century. There's an 18th century Scottish Enlightenment thinker, philosopher, Adam Ferguson. He warned in the 18th century of the risks to nations of excessive debt. And in fact, he's spoke about how that was the most significant predictor of structural decline for great powers. And you can apply that throughout history.
Okay,
so
which makes sense.
Yeah, and you see it, notably the British Crown tried to tax the Americans, and then you had no taxation without representation, the Boston Tea Party and the American Revolution. You had the French Revolution when the church and the First Estate, the Second Estate tried to put these crushing taxes on the Third Estate, and in particular the bourgeoisie. The very bloody French Revolution stemmed from that. And then you had the slow decline of the British Empire after two very costly world wars. So there's an economic historian, Neil Ferguson.
No relation to Adam Ferguson from the 18th century? No?
I don't think so. They're both Scottish, though.
Okay.
So Neil Ferguson has repopularized the work of Adam Ferguson and come up with Ferguson's Law, which he says is named after Adam rather than himself. But the law states that any country that spends more on interest costs than defense has crossed the tipping point of structural decline. So the US violated that law, Ferguson's Law, for the first time in modern history last year.
Okay, so let me just understand that. So Ferguson's Law says that if a country spends more on its debt's interest costs than it spends on defense spending, it has crossed the tipping point of structural decline.
That's exactly right, yeah.
So how has the US administration reacted then to effectively seeing their nation tip over into structural decline?
So it's fascinating. So Elon Musk went on Fox News before he teamed up with Trump, and he said, we violated this law. We need to do something about excessive government spending. We need a smaller government. We effectively need to audit the government. and we need government efficiency.
Yeah.
So you had the Department of Government Efficiency.
The Doge.
Doge, exactly.
Doge, yeah, I remember
that bromance lasted about as long as a primary school relationship. And with the collapse of that bromance, you also had the abandonment of any talk of austerity or fiscal conservatism. Now you have the fiscal taps wide open, pedal to the metal. The plan is to outgrow the debt. And that's why I say it's the economy and those great companies that could provide this saving grace.
Right.
If productivity is enough to outrun the debt, then everything is fine. And lower interest rates obviously help with that, which is why Trump is putting so much pressure on the Fed. But it's a risky strategy.
Yeah.
And if it fails, you then have the plan morphs again into the last resort of bankrupt governments, which is this universal tax of inflation.
So this sounds like there's 3 phases of this US macro government.
Yeah. Morphing strategy.
Yes. So first was they were pretty fiscally conservative.
Yeah.
Now they're trying to outrun the debt, but that could morph into a third phase, which is around inflating it away.
Exactly.
Okay, that's quite a lot going on. So what are the implications for our clients, for investors then?
Sure. So I suppose a way to look at it is financial repression.
Financial repression.
Yes. Taxation without legislation. So
Okay.
low interest rates, higher inflation, maybe you have more quantitative easing, currency devaluation. There are lots of different guises that this can take. But ultimately, as Keynes said, and I'm quoting him here, by a continuing process of inflation, governments can confiscate secretly and unobserved an important part of the wealth of their citizens.
So is it all this that's driving people to gold?
Absolutely it is, at least in a very significant part of it is. It's the rally in gold is about far more than just gold itself. It's about fiat money.
Fiat money?
Fiat money. So
not the car company?
Not the car company.
Okay.
But when a government can issue its own currency.
Right.
And gold is arguably the truest form of money.
Because it's not issued by a government.
It's not issued by a government. It can't be debased in the same way.
Okay.
It's untethered to central bank policies. It's outside of that what's called fiat system. So it can't be printed. But what we're seeing today is central banks, sovereign wealth funds, not just private investors, but we are seeing private investors all diversifying away from the US dollar and buying gold and looking for assets that provide protection against fiscal erosion. So there are other assets that do that as well, and it's important, I think, to have a thread through your portfolio that provides protection against this risk that is very relevant today and at the moment.
So you mentioned that this is a thread, a gold thread indeed, that can run through a portfolio. But what other strategies are there then beyond gold or beyond silver?
Sure. So Oxford University released a paper in 2021 that showed that there was no specific commodity that worked all the time.
Okay.
But a broad basket approach to commodities is the best way to hedge against inflation. So that's one, broad basket of commodities. Then there's inflation-linked bonds, which I think are attractively valued at the moment. Longer-dated inflation-linked bonds, where there are quite very attractive yields on offer, can protect against this scenario. So if you look at the US and UK inflation-linked bonds, you can earn a 2% real yield. That means you can earn whatever inflation is plus 2% a year over the lifetime of the bond. You have to accept a lot of volatility, but if you do hold them over the long term, that is the return that you will earn, and I think that's quite compelling. Then you have other alternative diversifying strategies as well, which are a key component, away from traditional assets of just bonds and equities. There are other strategies that you can trade there, and even within those traditional asset classes, there are specialist areas of equities and credit that can provide protection, whether it's mining shares or within fixed income asset-backed securities.
Okay, thank you. Well, in my takeaway coffee cup, this is what I've gleaned today. I've enjoyed our little trip into history of Ferguson's law and also the nice Keynes quote that you made. I understand the US is currently trying to outrun its debt and interest costs. through growth and stimulus. And this looks feasible because of the innovation that's going on in the US and the very successful companies out there. But overall, I think my takeaway was, against this fiscal backdrop and inflation uncertainty, there is a definite threat to the erosion of wealth. We talk about it being the robber in the night, inflation. So thinking about how to invest and broaden your portfolio to provide protection against inflation is going to be absolutely key going forward, I think. Maybe there's a bit of a gold rush, but other things are available. Is that right? Have I got that right?
Bang on. Okay. That's perfect.
Great. So thank you very much. My not such a great cup of tea has now gone cold, but thank you for listening to the podcast, and I'll speak to you again next week.
Thank you very much.
Thank you.
Investment involves risk. The value of investments and the income from them can go down as well as up, and you may not get back the original amount invested. Past performance is not a reliable indicator of future performance. The information provided is not to be treated as specific advice. It has no regard for the specific investment objectives, financial situation, or needs of any specific person or entity. It is accurate at the time of recording and is subject to change.